The stock market has a unique way of testing our patience. One day we are looking at record highs, and the next we find ourselves questioning if the growth story is suddenly over. It makes you wonder, how do we separate the temporary noise from the real long-term wealth creators? When the market gets volatile, the urge to react is strong, but history shows us that the most successful investors are those who can step back, look at the hard data, and remain objective.
It is the ultimate test of discipline. When we see these sudden market swings, everyone wants to know if we are looking at a genuine breakout or just another short-lived bubble. Today, we have some fresh data from the US Stock Picker podcast channel that might give us a much clearer picture of where the smart money is actually moving, especially within the technology sector. The key is distinguishing between companies that are rising on pure hype and those backed by undeniable fundamental strength.
That distinction is exactly where we need to start. When we look at the technology stock predictions coming out of the channel, there is a lot of excitement around high growth names. But as investors, we have to ask ourselves a fundamental question. Are these true growth stock picks with sustainable long-term upside potential, or are they just temporary pop stocks driven by retail momentum?
To answer that, we have to look at what lies beneath the surface. The US Stock Picker podcast channel recently highlighted a group of technology stocks that are not just riding a wave of positive sentiment. They actually have the underlying numbers to back up their valuations. When we analyze these companies, we look at metrics like earnings quality, revenue growth acceleration, and operational leverage. It is easy for a stock to pop on a single good news headline, but sustained upside potential requires a business model that can scale efficiently without burning through cash.
Let us unpack that idea of scale. Often, when people see a stock rising rapidly, their immediate reaction is the fear of missing out. They jump in at the absolute peak only to suffer when the market corrects. But if we look closely at the fundamental structure of the companies highlighted by the US Stock Picker podcast channel, some of these businesses are growing their top-line revenue at 30% year over year, while their operating margins are expanding even faster. That suggests real structural strength, doesn't it?
Absolutely. It means they possess significant pricing power. In a challenging macroeconomic environment, pricing power is everything. If a company can pass rising costs onto its customers without losing demand, its earnings will continue to grow, regardless of external pressures. The US Stock Picker podcast channel's analysis shows that the companies currently leading the rankings are those with a high return on invested capital. They are reinvesting their cash flow into high-margin projects, which creates a compounding effect over time. It is like building a house on a foundation of solid rock rather than shifting sand.
That is a powerful analogy, yet we cannot ignore the volatility. For a swing trader, volatility is the lifeblood of their strategy. For a long-term investor, however, it can be deeply unsettling. How should we view this tension between short-term market fluctuations and long-term intrinsic value?
It really comes down to your personal time horizon and investment strategy. For a swing trade, you're primarily looking at technical indicators, moving averages, relative strength index, support and resistance levels. You want to capture a quick 10 to 15% move over a few weeks. But for long-term growth stock picks, you have to train yourself to ignore the daily noise. You're buying a piece of a business. If the business is executing its strategy, a 20% drop in the stock price is actually a buying opportunity, not a reason to panic and sell.
It requires a major shift in mindset. We often talk about market trends as if they are purely mechanical, but they are driven by human psychology. When fear takes over, even the most solid technology stock predictions can look questionable to the average investor. How does the current market sentiment align with the actual data we are seeing?
Right now, we are seeing a fascinating divergence. The news sentiment is somewhat cautious, even anxious, due to macroeconomic uncertainties and interest rate fluctuations. Yet, the corporate earnings reports for these specific growth stocks remain incredibly robust. This gap between negative sentiment and positive fundamentals is often where the best investment opportunities are born. When the market panics, high-quality assets go on sale.
Let us look at the risks, because every high-reward scenario has a corresponding risk profile. If we look at these technology stock predictions, what are the primary threats to their upside potential? Is it regulatory pressure, intense competition, or perhaps just overvaluation?
Valuation is always the immediate concern. When market expectations are sky-high, even a minor miss in quarterly earnings can cause a sharp knee-jerk correction. That is why we look closely at the PEG ratio, price earnings to growth. A high PE ratio might look intimidating on its own, but if the growth rate is equally high, the PEG ratio might actually suggest the stock is fairly valued, or even undervalued. The US Stock Picker podcast channel emphasizes finding companies where the market is underestimating the duration of their growth.
That makes sense. It is not just about how fast they grow this quarter, but how long they can sustain that growth. If a company can maintain a 25% growth rate for 5 years instead of just 2, the valuation today looks very different.
Exactly. That is the core of finding true upside potential stocks. It is about longevity and defensibility. Whether it is proprietary software, high customer switching costs, or strong network effects, a solid moat protects those future cash flows.
As we wrap up this discussion, let us distill this into actionable insights for our listeners. If someone is looking at the market today, wanting to apply the strategies from the US Stock Picker podcast channel, what is the concrete game plan?
Let us break it down systematically. First, looking at the news sentiment, it is currently leaning towards cautious optimism. There is short-term anxiety, which means we should expect continued volatility, but the underlying sentiment for technology growth remains structurally bullish. Second, for our fundamental and strategy analysis, the focus must be on high-margin software and hardware companies with strong balance sheets. Look for positive free cash flow and a PEG ratio below 1.5. Third, on a swing trade analysis level, we are seeing a clear consolidation range. The market is establishing defined support levels where buyers consistently step in. Fourth, regarding when to start investing, our recommendation is to avoid buying on massive green days when FOMO is high. Instead, look to build positions incrementally during market pullbacks, specifically when the index or the specific stock tests its 50-day moving average. Fifth, for the entry point, if we look at our top growth pick as an example, a strong price point to start investing is around the $150 level, where we see major historical support. Sixth, knowing when to leave the market is just as critical. You should plan your exit if the fundamental thesis changes. For example, if revenue growth drops below 20% for 2 consecutive quarters, or if the stock breaks its key long-term support levels on high volume. Finally, to mitigate risk, we recommend setting a strict stop loss. A prudent price point to leave the market and protect your capital would be around the $138 level, which is just below the major support zone. This limits your downside while keeping you positioned for the upside.
That is a very clear roadmap. It takes the emotion out of the equation and replaces it with structured execution. Thank you for breaking that down so clearly.
It is all about managing risk while letting your winners run.
To all our listeners, thank you for tuning in to this episode. Remember to stay disciplined, keep analyzing the data, and make informed decisions.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. SEO, optimized video. Title, Top Growth Stock. Picks with 10x, upside potential stocks. A technology stock predictions and pop stocks revealed on the Stocks to Trade podcast.